options, those options are called finance sources. So for me as a businessman, or for me as an individual customer of the bank, retail customer of the bank, we have some sources called financial sources, right? So they are generally compared in terms of long-term financing and short-term financing. So today we are going to study what are those different sources of funds or finances in terms of long-term and short-term, and why they are used in short-term and why they are used in long-term. ये आज हम समझने की कोशिश करेंगे. Finance is the lifeblood of business. This is what is normally said, because without finance, you cannot run any kind of business, any kind of entrepreneurial opportunity, any kind of profit-making initiative cannot run without finance. The first thing that you need while you start the business, while you expand the business, while you diversify the business, the only way to do that is through finance. No business can be carried on without the source of finance. अब सबसे important बात ही ये है कि if we look at the business, anytime if our assets go down in comparison to liabilities, the moment that happens, we call that particular situation bankruptcy. We call the company, we call the organization bankrupt. Why? Because they do not have sufficient assets to pay back liabilities, and that is the position from where the person starts to go down. And that is where what your finances are, how you have managed your finances, how efficient finance structure you have in your organization, that comes into effect. And we all remember that we have studied in financial management last year in the 3rd semester that what is a capital structure, what is the finance, what is capital budgeting, right? This is all about efficient financial management, right? So how you have carried yourself in the market, that is what is efficient financial structure. So there are several sources of finance, and as such the finance has to be raised from the right kind of source. And we all know in capital structure, we have tried to understand what are the different sources through which we can raise capital, whether it is a short-term capital or a long-term capital. There are different sources specified for long-term capital. There are different sources specified for short-term capital. Short-term capital is meant for working capital management. Long-term capital is meant for capital budgeting. You need to buy assets. You need to enhance your business. You need to secure your business. So these are your long-term needs. So you need to clearly differentiate between the needs that you have, and on the basis of that, you get finances. Let us quickly move to the 3 different sources of finances. First is security financing. Second is internal financing. Third is loan financing. These are 3 different areas through which you can raise finance. The first area, as you can see, is security financing, in which we see equity shares, preference shares, and debentures. Very, very clearly, this is a long-term source of finance. This is a long source of finance. Some of these areas are really difficult to manage, though these are good areas to invest into, but these are difficult areas to manage. For example, let us pick up the example of equity shares. What is equity shares? That you go to the market and tell people that you need capital. People start buying your shares and they become members, they become owners of your organization along with you. In small capacity or big. Then what is organization's responsibility is to return to them sufficient amount of dividend every year and appreciation of capital every year. Appreciation of capital means what is the price of equity shares? What is the price of equity shares every year? So this is what the security financing of equity shares is. हाँ बोलो आकाश, कुछ पूछ रहे हो आप?
हाँ यस सर. सर जब हम इक्विटी सर रेज करते हैं तो सर हमारा एग्रीमेंट बनता होगा ना, मतलब जितने रुपए हम रेज करते हैं.
देखिए एग्रीमेंट ये थोड़ा अलग तरीके का ट्रांजैक्शन होता है. इसमें क्या होता है कि आपके पास एक रेड हेरिंग प्रोस्पेक्टस होता है जो कंपनी रिलीज करती है बिफोर यू बाय इक्विटी शेयर्स. आईपीओ वगैरह आता है, इनिशियल पब्लिक ऑफर, अगर आप इस टर्म को गूगल करेंगे तो आपको काफी जानकारी मिलेगी. मैं आपको एक on the very higher level I will tell you that what happens. So company issues are adhering prospectus via SEBI and a banking organization, right?
नहीं सर, वो मतलब जैसे वो सर बीसी से फंड रेज करते हैं सर, वो वाला.
नहीं, that is a different thing. उस पे अभी हम नहीं आए हैं. वो एक अलग चीज है. देखिए, बहुत इंपॉर्टेंट बात ये है कि वो एक अलग एक्टिविटी है. वो आप तब करते हैं यूजुअली जब आप बिजनेस स्टार्ट करने वाले होते हैं, जब आपको जीरो फाइनेंसिंग चाहिए होती है. जीरो फाइनेंसिंग का मतलब आप अभी कंपनी स्टार्ट कर रहे हैं, मान लीजिए स्टार्टअप कैपिटल लगा रहे हैं, तो आपको पैसे कौन देगा? आप आईपीओ लेके तो आ ही नहीं सकते. आईपीओ तो वो कंपनी लेकर के आएगी जो ऑलरेडी एस्टैब्लिश्ड है मार्केट में, जिसको फर्दर फाइनेंसिंग की जरूरत है. आप समझ रहे हैं बात को? जो वेंचर कैपिटलिस्ट होते हैं वो फंड तो डिफरेंट तरीके से ऑपरेट करता है. वो आपको तब फंड देगा जब आपके पास कोई बहुत अच्छा बिजनेस आइडिया है, आपकी नेटवर्किंग है, आपके पास प्लान है कि आप अगले 10 साल में क्या करने वाले हैं. वो आपका प्लान देखेगा, समझेगा और आपको फाइनेंस करेगा, राइट? वो भी आपकी इक्विटी शेयर्स ही खरीदेगा शायद. लेकिन द पॉइंट इज कि दैट इज अ डिफरेंट स्टेज, दिस इज अ डिफरेंट स्टेज. ये अलग टाइप की फाइनेंसिंग है, वो अलग टाइप की फाइनेंसिंग है. इक्विटी शेयर्स, इक्विटी शेयर्स के अंदर दो अलग अलग सिचुएशंस आएंगी. ठीक है, तो अभी हम आईपीओ की बात करेंगे, जनरल शेयर्स की बात करेंगे, राइट? और उसके बाद वेंचर कैपिटलिस्ट की बात करेंगे. ठीक है, चलिए. So equity shares are these, and there is a very high risk element. If you are not able to give sufficient dividend to these equity shareholders, if you are not able to appreciate the capital as expected by equity shareholders, there is a chance that these people would like to quit equity shares. They would like to sell your equity shares. They would like to return your equity shares. This is a very risky element. However, it is the ownership based business. Everybody knows the difference between preference shares and equity shares. Preference shares will have preference of 6%, 10%, 5% of dividend every year. So whenever profit happens to take place in the balance sheet, what happens is you first distribute profit to these preference shareholders, and thereafter remaining amount is distributed to equity shareholders. So you know what is your liability in terms of preference shares. So this is the second method of financing. Third method of financing is your debt financing. Debt financing is that you take a kind of long-term loan in terms of debentures. Debentures are basically a type of paper, legal paper, right? And that paper you buy from the person who is selling debentures. You buy it, that paper is a kind of loan. You say that you sign that agreement with the debenture holder, right? And then what you do, you start getting interest every year on agreed basis, and you have given a big sum of money to this company, right? For example, I am a corporate organization, I sell debentures, I make papers, I say that okay fine, you give me 10 crores against which I will give you 5%, 10% interest every year, and after 10 years I will return this 10 crore rupees to you, right? You are a debenture holder, you bought it, and you are getting interest every year. Now this is a different kind of setup. This is a debt finance. It has nothing to do with profit. Every year you have to pay interest, you have to pay interest. There is no choice. I don't have profit, I cannot pay you interest. That's not the question. Interest is charged on profit and loss account before the profit is calculated. You know what is profit and loss account, the final accounts. So debenture interests, these are charged on profit and loss account before profit is being calculated. So whether you are in loss or profit, irrespective of that, you have to pay this particular money. Internal financing. Internal financing, now there are two very traditional, conservative, and popular methods of financing. One is that every year out of profit, you create some part of it as general reserve or reserve for specific purposes. And we have all studied reserve for bad and doubtful debts, reserve for fire, reserve for, general losses, general reserve. These kind of reserves and provisions are created in the balance sheet via profit and loss account. So you charge your profit and create these kind of retained earnings, and through which you would like to help your business in certain initiatives. Depreciation fund. You all know that you create a depreciation reserve for assets, because every year assets would go down by certain value because of the wear and tear and general usage of the asset. What you do, you bring down the asset value by creating a fund initially in the year. Every year you do that. While making the profit and loss account, you bring up depreciation fund. And what you do, whenever there is a depreciation, you use this fund to support depreciation rather than, decreasing the value of your asset. And this is a way of smart financing. So you basically don't put pressure on your assets. You don't put pressure on your profit and loss account unnecessarily. Rather than creating depreciation, you create a depreciation fund. And whenever the value of asset gets depreciated every year, you support that depreciation through your fund rather than putting pressure on your profit and loss account. The last method is loan financing. Now, loans are again short-term and long-term. As I discussed, long-term needs are capital budgeting needs. You want to buy a building, you want to buy vehicles, equipment, you want to buy, a plant, a factory. These kind of initiatives are supported by long-term financing, 5 years, 6 years, 10 years. Even when you look at consumer lending of banks give loans for cars and, houses or construction or these kind of things, renovation. These are for 5, 6, 10 years, 20 years. Housing loan is for 20 years. So these are long-term sources of finance. Similarly, when you look at short-term financing, these are loans generally payable in 1 to 2 years or 3 years maximum. Examples of short-term financing in business lending, commercial lending is a discounting of bills, bank overdraft, right? You are running short of funds. You just went to the bank and said, can you give me some advance? So short-term advance has been given by the bank, which is payable in 6 months, for example. These are short-term financing, which are required for the purpose of working capital management. We have studied working capital management last year. You want to manage your salaries, taxes, short-term liabilities, current liabilities, for which you raise short-term finance. Long-term finance, as I said, is for the purpose of capital budgeting, where you need long-term finances to buy assets, to enhance your business, to enhance profitability. So these are your long-term and short-term finances. So your long-term sources of funds, as I said, shares, debentures, venture capitalist. Now let us go to that particular topic that we were discussing. Akash, aapne question pucha tha. What is venture capitalists? So venture capitalists are basically huge funds created by various entrepreneurs, big money lenders in the market, capital owners in the market. These people, they basically start creating big funds in the market. Big funds are like 1,000 crores, 1,500 crores, 2,000 crores, 50,000 crores, and they look for ideas. They say that we are going to give you money only when you give us ideas, better ideas, good ideas. And you have decent plans around that. You know how to execute those ideas. You know from where to go for resources, except money. We'll give you money, but you need to tell us your plan. How would you manage your finances once I give you this 100 crores, for example? How do you manage technology? What is your business idea? How the business idea is going to be costed? How the business idea is going to earn revenue? For how long you would stay in the cost benefit? What is the cost benefit analysis? For how long you would stay within the cost? And then for how long you will make profits? How profitable your business is? How sustainable your business is? Based on these ideas, these areas, you make a presentation and venture capitalists basically grant you loans. But this is not a very simple activity. Somebody who is having a 100 crore, 200 crore fund for you would not like to give you fund just like that. He makes a very sure point that the business is going to be successful. Now let me share some ideas like there's a company, there's a fund called SoftBank, which was created in Japan. This SoftBank was created with a purpose that, you know, you raise money from people, 1 rupee, 2 rupee, 10 rupees, 100 rupees, and they created a huge fund of some 1,000 crores. And then they asked technology companies. Technology is future. We can see things are getting delivered through drones. So technology companies, they called for technology companies to come and give presentations and convince SoftBank that they would be able to do a viable, sustainable, environment friendly, long-term profitable business. So companies like Ola, the actual name of Ola is not Ola. It's I forgot the name. 24/7 Technologies. No, there's a different name. The actual company is a technology company which is running Ola. They do not earn cabs. They do not employ drivers. They only employ technology staff. But they are very successful. And why they are successful? Because they have created a technology platform which brings all taxi drivers, taxis, consumers, lenders, bankers, payment platforms together in one place. Uber, for example, which is actually the idea generator of the globe. Uber started this idea that we don't have to own taxis. We don't have to own drivers. We don't have to employ drivers. We don't have to give finance. Bank would do that. We will give them a platform that you run a taxi. We'll give you customers. We'll create a platform which will give you finance. And we'll give you a platform from where you will get a permanent revenue. They created, Uber is the first company in the world which created this idea of delivering taxi services door to door using smartphones, Google Maps, and things like that. And Ola followed it up because it was not possible for Uber to spread across the globe, particularly countries like India. India is a vast country. You need to have a huge setup in India to run taxis. And it is not very easy also. So Indian entrepreneurs, they went to SoftBank Japan, made a presentation and got capital fund from venture capitalists, VC. Flipkart was owned by Sachin Bansal, Binny Bansal. Both the brothers, they went to venture capitalists. SoftBank was one of them. There is a Chinese entrepreneur whose name is Jack Ma, who owns Alibaba. Alibaba is basically the Chinese tycoon company for this online trading, just like Amazon, Flipkart in India. They are the people. They financed a number of companies in India. Flipkart is not financed by anybody. Flipkart was not financed by anybody in India. It was financed by companies in China and Japan. But the owners, initial owners, Sachin Bansal and Binny Bansal, they were from India. They gave the presentation. They were Indians. They made a presentation. They got it. They got the finance. So the actual money invested in the company, you do not know whether it is coming from India, America, China, Japan, Malaysia, or wherever. We don't know that. Government grant. Now there are certain areas, certain priority sectors where government gives grant. And they convert that grant into a long-term loan or a long-term source of finance. Sometimes, but this is very rare, that the government goes ahead and buys the shares of that company. Now it does not happen that much, but earlier it has happened. Before 2000, government had a strategy when the, for example, the company is of public utility, it is of very high importance, and public confidence has to be restored in the company when, you know, the company is going bankrupt, etc. Government used to go ahead and buy the shares of the company and used to become the owner of that organization. Now it does not happen. Government has started selling off, you know, the companies which are under its remit, under its ownership. So government grant is one more area. With relation to government grant, I would like to invoke certain areas where, what are those areas, what are those priority sectors where government is interested in giving loans? in giving grants, right? Let us just quickly understand that as well. There is, so when government invests, when government directs investment agencies, banks, financial institutions to attract more investment, more money, more capital into certain sectors, those sectors are called priority sectors. That preference should be given to these areas by banks, financial institutions, investment agencies to boost the economy. These are the areas from where we can get the maximum GDP. We can churn the maximum capital to create profits, to create employment, to create revenue, to create tax sectors. So priority sector lending has a very important role, and Reserve Bank of India also focuses through the banks on these areas to get maximum churning of capital. Right. So the most important thing is if somebody wants to invest into an area, that has to be seen whether it is a priority sector by the government or not. Recently, after these COVID crisis, I do not know whether you go through these newspapers or not. Dr. Manmohan Singh wrote an article, and he wrote an article that government now needs to reprioritize its preferences, because COVID has hit us so hard that we have gone at least 10 years back. So 2016, we saw demonetization, which took us another 5 years back. Now this COVID has taken us another 5 years back. But if we can capitalize, if we can reprioritize our sectors of investment, our sectors of priority, then probably, the banking and financial sector can get a boost once again. If these sectors can get a boost, priority sectors would get boost automatically. So we recorded a 20% growth in last quarter. How that is possible? That means there is an opportunity available to be tapped. Indian market is always an opportunity market. We are not a rich country. We are growing rich, but with a very slow pace. We have a production capacity. We have a consumption capacity beyond expectations. We have a youthful country. We are the youngest country in the world. We have crossed China already, and we will remain young until 2050. So we have how many years? 29 years. So we can surpass China and any other country in the world which is growing beyond us, which is above us. So priority sectors define that what is the strength of your country. The first sector that government has created, and it is called priority sector for ages now, for ages, is agriculture and allied activities. So direct finance to agriculture and agriculture related food processing, agriculture related other industries which are dependent on direct agriculture. These are to be financed directly by the banks, financial institutions, micro institutions, microfinancing institutions, etc. for short-term, mid-term, and long-term finances. So you help farmers. So banks and financial institutions are instructed to help farmers, self-help groups, joint liability groups, JLGs, individual farmers up to the level of 20 lakhs. Indirect finance to agriculture shall include loans given for agriculture and allied activities, which are there in Section 1 of Banking Regulation Act and NABARD Act. We will talk about that as well. So these are two types of credits which are to be allowed for agriculture and allied activities. So when you say priority sector, if a farmer or allied agricultural businessman or allied agricultural activity person goes to bank for a loan, he has to be given loan on priority. His application would be treated in the first place by the bank. not like an individual consumer lender, individual consumer borrower like me who will go for a car loan. Mine is definitely priority 2, not priority 1. Small scale industries, again, the focus is on small scale industries because we know there are a number of establishments that Indians are running at homes. They are producing things at home, whether it is small potato chips frying pan that you are using to fry potato chips, making potato chips or banana chips at home, or it is making inverter at home. Noida used to be at one point in time hub for creating and manufacturing inverters. Small, big, commercial, different types of inverters, were being manufactured in and around Noida. So these are small scale industries. Even some of them are cottage industries. You're running at home with very small amount of finance, but government wants to promote it. As much production as possible in these areas would boost the gross domestic product, the GDP of the country. Why? Because you imagine a situation that even if, for example, we have 10 crore small scale manufacturing organization in India, imagine the kind of output they are producing for the country. Imagine the number of customers that are buying. Even 5 customers are buying from each of them. They would create a customer base of 50 crore customers. So you have a consumption capacity in your country. That is why small scale industries are promoted. You go to Firozabad, you will find those glass bangles or glass related manufacturing organization. Small factories are working. They have invested less than 1 crore in their factory. And they are involved in direct exports. They are all export oriented units. But the problem is that they don't get proper finances. So again, there are different types of directions from central government, Reserve Bank of India to finance them directly or indirectly. Small business and service enterprises. Now, these are interesting areas. Small businesses are retail trade, self-employed persons, small road and water transport operators, other service operators, small restaurants, right? Roadside tea sellers. These are the people who are falling in the category of small business and service enterprises. And recently what government did, they created a 20 lakh crore project for, meeting out the problems and challenges posed by COVID-19 last year. What they did, while creating the schemes for 20 lakh crore, they said that even rediwalas and people who are selling vegetables on thelas inside colonies, they will also get cards. They will also get financing. Maybe at a smaller level. Microcredit. That is what that finances. Provision of credit and other financial services and products for very small amounts not exceeding 50,000 per borrower. To the poor in rural, semi-urban and urban areas. So microcredit has been created where you can get credit up to rupees 50,000, but not beyond that. Education loans. This is another priority sector that government wants people to study, students to study, even poor students to study in higher educational institutions like IITs and IIMs, so that talent can be reaped, cultivated in those institutions, and ultimately they turn up into entrepreneurs, technologists, establishing companies, creating employment, boosting GDP in the country. So educational loans are to be given, because if you want to study in IITs and IIMs, the minimum cost is 30 lakhs. 30 lakhs a year for a poor family, even for a person who is living a middle class family in Delhi, who is running a middle class family in Delhi, would not be able to invest 30 lakhs every year. If it's a 3 years or a 4 years program, imagine it grows beyond 1 crore. So that is what his education loan is for. Students who go abroad, they are given loans by Indian banks. Why? Because obviously they will go abroad, they will get name and fame, they become technologists, they become entrepreneurs. They get decent packages. They'll be able to pay back education loans. They'll be able to create money for India, outside India, through NRI investment funds, etc. Housing loans. Housing loans are another GDP booster in the economy. Loans up to rupees 28 lakhs in metropolitan cities, and above 10 lakhs and up to 20 lakhs at other centers for construction or purchasing of dwelling units per family. So there are different rates in metropolitan areas, non-metropolitan areas, rural areas, and far-flung areas. Repairs to the damaged houses, or the cost of repairs for the damaged houses, that is separately given. But the point is, why do you want to do that? Because creating a dwelling unit would create different types of employment. Now, if you create a dwelling unit is where you live. If you create residential units, you start getting taxes. You start consuming electricity. You start getting electricity bills, electricity distribution, and producing companies, they start getting profit. More employment. Nearby areas would get markets. Through markets, you get sellers. Through sellers, you create consumption capacity. Through consumption capacity, you raise standard of living, and so on. So just by giving housing loans and creating more housing units, these are the areas that get financed. That is why this is a priority sector for the government. Weaker sections of the society, small and marginal farmers, farmers having no land, artisans, village and cottage industries where individual credits do not exceed 50,000 rupees. I talked about micro credit with a special feature of artisans, village and cottage industries. Beneficiaries of Swarna Jayanti Gram Swarojgar Yojana. Now this is also called National Rural Livelihood Mission. Scheduled castes and scheduled tribes, if they are involved into any kind of trade, they are called weaker sections. Any kind of trade, they are required to be supported by the government agencies, banks, financial institutions. Differential rate of interest scheme for beneficiaries of various agricultural, allied agricultural activities, weaker section of society, very small businesses or small scale industries having less than 20 lakhs capital. So these are the priority sectors. Beneficiaries under the scheme of rehabilitation of manual scavengers. Now the most important thing is India is still having manual scavenging. Manual scavenging is मेला ढोना, जो लोग मेला ढोते हैं, वो नहीं होना चाहिए. India's constitution does not allow people to do manual scavenging, but it is still happening. But government is trying to put as much focus as possible on these areas to rehabilitate people who are involved in manual scavenging, and they are being moved into different areas. So it is important that if there is an agency, if there is a company, there is a corporate which comes into forefront and says that we are going to create employment opportunities for those who are into manual scavenging, they are required to be given finances on priority. Loans to distressed persons other than farmers. Distressed persons are like people who have committed suicides, who had lost money, who had lost property, money, fields, crops due to floods, earthquakes. They are all called distressed persons. War victims, for example, they are all distressed persons. They are to be given credit on priority. Individual women beneficiaries up to rupees 50,000 per borrowers, right? The amount holders under Pradhan Mantri Jan Dhan Yojana. This is another one that somebody was talking to me last time about Mudra Yojana. Mudra loan can only be given to account holders under Pradhan Mantri Jan Dhan Yojana. And Mudra loan can be given very easily. You don't have to go to venture capitalists. You can get finance for Mudra Yojana from any of the bank if you have a decent idea to start the business. Or if you already have a business, you want to expand it, you can discuss it with the bank and bank can, give you the advance. So these are different types of priority sectors that I was talking about where the government grant is given. Bank loan, we have already discussed that. Mortgage. Mortgage is very interesting kind of an example which comes under unsecured long-term lending. So when the government is, secondly, banks or financial institutions, they give you loan for a long-term period of 10 years, 15 years for a very huge amount like 10-50 crores. They would like to secure one of your assets. And that process of creating a charge on your asset, is basically that how would you secure the asset with the bank. So bank will sign the papers with you, and it will create a charge on your asset that if you are not able to pay your financed fund in time, the bank will have a right to forfeit the asset and sell it in the open market to recover the debt. And that is what is called mortgage. Mortgage is one process of that. In the next class, we will surely discuss what is mortgage and other kinds of charges that are created on assets for secured lending. But this is what is mortgage. Owner's capital, we have already talked about it. Internal accrual, we have talked about creating the funds, general reserve, provision for specific purposes, right? That retained earnings, depreciation fund, these are internal accruals. What are the needs for long-term finance? So long-term versus short-term, as I said, we have already discussed that. Long-term is for capital budgets. For short-term, you are looking forward for working capital requirements. Long-term is required for modernization, expansion, diversification. You require huge quantity of funds, but it is an irreversible decision. Why I'm calling it irreversible decision? Once you take a loan of 10 crores, you have to pay 10 crores along with interest back. You have to invest those 10 crores and get some returns out of it. Otherwise, your business will be bankrupt very soon. 10 crores is not a small amount. And we have discussed a number of examples where huge debt was taken and then the company became debt laden and it could not do anything. It's an irreversible decision. You're not taking 5 lakhs or 10 lakhs. These days, smaller companies taking 5 to 10 lakhs loans would become debt laden if they're not able to invest that money in the right direction, if they're not able to efficiently use that fund, if the effective decision, right place of investment, right time of investment is not identified, that loan becomes load on you, and that load would explode exponentially in a very short time, because you have to pay back to the bank. One, secondly, the areas where you have invested, you have to return to those areas as well. Not just the bank is sitting over there, you are owners sitting on your head, investors sitting on your head, government sitting on your head for taxes. There are different interested stakeholders in the business who are looking for their share for the business. Government is looking for taxes, investors are looking for returns, capital is looking for interest appreciation, creditors are looking for their loans, banks are looking for interest for finances, consumers are looking ahead for products, better products, quality products. And if you are not able to offer anything to them, obviously your business is at a toss. You're moving towards bankruptcy. Asset liability mismatch, interest rate risk, and liquidity risk. These are the 3 challenges that you get when you go for long-term finance. Along with long-term finance, there is a big risk of having an asset liability mismatch. That is what I was talking about just now. Your liabilities go up and your assets go down. This is what is mismatch of assets and liabilities. Interest rate risk. Interest rates are really high when you go for long-term financing. And liquidity risk. There is a higher chances of liquidity coming down. Liquidity is what? How much cash do you have? How much stock do you have? How much securities do you have? All your current assets is your liquidity. Cash and immediately convertible into cash kind of assets. These are your liquidity capacity. They indicate your liquidity ratio. So if you have taken a huge long-term finance, obviously you have to pay the interest and invest this amount into right areas to generate profit as early as possible. If that's not happening, obviously your liquidity is gone, because you have to pay interest. Bank will not stop. Bank will not listen to the idea that, I have just invested, I have just not got profit. Interest, debt is not associated with profit. It's agreed with the bank that you will have to pay this money back. Security financing. What are the benefits, pros and cons of equity share capital and preference share capital? We have discussed that. I think you need to go into the details further. Let me know if you have questions. Debentures. We have discussed this as well. You have to go into the details, study. Long-term loan, we have discussed this as well. Term loan, this is also we have discussed. This is a process through which you get a term loan. Securitization process, this is when you go ahead with security financing, equity shares, preference shares. So how does it happen? So this is the structure through which you get the security. This is a structure through which you get the security. You are the originator. You appoint a collection agent, right? You special point of value contact you create for the purpose of sale of assets. Through this, you will create an original loan. These are obligors, banks, financial institutions, right? Through the SPV, you will get credit enhancement providers. Rating agency will give the SPV points that whether this value initiative is good enough or not. Structurer, he will give a structure to the entire initiative of taking preference shares or equity shares in the market. They bring up your IPO. They give the final structure to your IPO. And these people are investors. They are in contact with SPV. They invest into this SPV. So the SPVs can be your venture capitalists. They can be general public investors. They come from general public investors, existing company owners. Anybody can be an investor. They subscribe to SPV program. And through SPV, the originator will get a loan. So actually, equity shares or preference shares are what? They're technically loans. You have to return money to them in the form of dividend. Otherwise, they will return money. They will return their shares to you, and you have to give them money. Another method is leasing versus hire purchase. So you have to see that whether you want to keep the ownership of that particular asset or you want to sell it off completely. These are the two methods. Leasing is where you keep the ownership, you give the assets for the use and keep taking charge every year. That's what is leasing. Hire purchases, that you have an agreement with the buyer, you sell the asset is used by the buyer on hire basis until he pays the last installment. Once he pays the last installment, the asset is owned by the buyer, not by the owner. But during the process of installments, the owner of the asset, the seller remains the owner of the asset. So basically, it's a hire model, that it's a rented property. You keep giving me the money until the last installment. Last installment is given. I'm not the owner anymore. Right. So this is another way of making money, another way of taking finance. Other sources of long-term finance, we have discussed this. Now questions. ये आज आपका एक पोर्शन और मैंने कंप्लीट कर दिया है